Over the last few years, Wall Street and investors have poured hundreds of billions of dollars into the AI trade. Companies are spending record amounts on GPUs. Look at NVIDIA. Record amounts on memory. Look at Micron. Record amounts on networking equipment. Look at Broadcom. And if you look at stock performance, investors have been rewarded for getting that story right. But are we thinking about this correctly? Because before you can build AI models, before you can fill a data center with GPUs, before you can scale compute clusters, something else has to exist first. To find out, I dug into the data, analyzed infrastructure growth, studied power demand trends, and modeled what happens if AI demand continues accelerating. And what I found completely changed how I think about the AI trade. And with that, welcome everyone. This is Data Divided, where I break data into what matters. I quickly want to touch on my background so you understand the lens that I'm bringing to this analysis. I have over 13 years working as an analyst, mostly in the wealth management space. My education, I have a bachelor's in finance, an MBA, and a master's in data science. I will be bringing kind of more of a data science approach to this. We'll do a lot of modeling, things at the end, but I think this should be a really interesting video here to cover or topic. And if you'd like to support the channel, there's a couple ways to do that. You can like, subscribe. There's a buymecoffee.com/card analyst. It's a place where you can leave a tip if you really got something out of this. Also, I have an eBay store where I sell sports cards. I have another channel where I open sports cards and talk about different aspects of that. That's a big passion of mine, so go check that out. I appreciate it. Before we go further, there's one concept we need to understand first. When people talk about AI, they are usually talking about the companies, products, and technologies they see every day. But AI isn't a single company. It isn't a single product, and it isn't a single technology. It's an ecosystem, a stack of interconnected industries and infrastructure that all have to work together for AI to exist. And understanding that stack is critical if we're going to answer the question we started with. Are we thinking about the AI trade correctly? When most people think about AI, they think about the end result. They think about ChatGPT. They think about AI models. They think about the applications they interact with every day. But AI doesn't start there. It starts with infrastructure. Every AI model sits on top of a much larger stack. At the foundation is power and energy infrastructure, electricity generation, transmission, grid capacity. Without power, nothing else in the stack exists. Above that are physical data centers that house the equipment, then the semiconductor ecosystem that designs and manufactures the chip powering modern AI, then the memory and networking equipment that allows those systems to move and process enormous amounts of data, then the compute clusters that combine all of those components into large-scale AI systems. And only after all of that do we reach the models and applications that most people associate with AI. The reason this stack matters is simple. Every layer depends on the layer below it. You can't deploy AI models without compute. You can't build compute without chips. You can't operate chips without data centers. And you can't power data centers without infrastructure. So if we're going to understand the AI trade, we can't just look at the top of the stack. We need to understand the entire system, okay? So now that we understand how the AI ecosystem is structured, the next question is, so how has the Wall Street trade played out so far? Before we look at the results, a quick note on methodology. For each AI theme, I built a basket of representative companies using publicly traded stocks tied to that part of the ecosystem. For example, the compute bucket included companies like NVIDIA, AMD, TSMC, and ASML. The memory bucket included companies such as Micron, Samsung. The networking basket included companies like Broadcom and Arista Networks. I then calculated annual basket performance using equal weighted returns for each group. and compared how the different parts of the AI ecosystem performed over time. And what you're looking at here are annual basket returns across multiple themes connected to AI. Okay. A few things immediately stand out. First, NVIDIA and the broader compute trade dominated early. In 2023, compute returned more than 100%, making it one of the strongest performing themes in the market. But what's interesting is what happened next. The market didn't abandon compute, it expanded beyond it. In 2024, power generation, nuclear energy, cooling, and electrical infrastructure all began posting significant returns. Then in 2025 and 2026, networking, memory, and data center infrastructure joined the move as well. In other words, the AI trade didn't rotate from one theme to another, it widened. More and more parts of the ecosystem started participating. And that's an important observation because it tells us investors have already recognized that AI is bigger than GPUs alone. Capital has been flowing into multiple layers of the stack. But that raises another question. What's driving all of this spending in the first place? To answer that, we need to look at the companies building the infrastructure behind the AI revolution. So who's actually funding all this? Because AI infrastructure isn't cheap. Data centers aren't cheap. GPUs are definitely not cheap if you try to build a computer, and somebody has to pay for it. The answer is a relatively small group of companies you've probably heard before: Microsoft, Google, Meta, and Amazon. These companies operate some of the largest cloud platforms and data center networks in the world. And over the last several years, they've been spending at a scale we've rarely seen before. What you're looking at here is a snapshot of the AI infrastructure build-out that was underway in 2025. Microsoft committed roughly $80 billion. Google committed approximately $75 billion. Meta guided to between 60 and 65 billion. And Amazon's capital expenditure exceeded $100 billion. Collectively, we're talking about hundreds of billions of dollars being invested into AI infrastructure, data centers, compute, networking, cloud capacity, and AI systems. What's important isn't the exact number, it's the scale. These companies weren't making small incremental investments. They were making massive bets on the future demand for AI, and they weren't doing it independently. All four companies were moving in the same direction at roughly the same time. And that tells us something important. The AI build-out wasn't being driven by one company. It was being driven, or is being driven, by an entire industry. And once that much capital starts flowing into infrastructure, it has real-world consequences. Buildings have to be constructed. Equipment has to be installed. Power has to be derived. Which brings us to the next question. What did all this spending actually create? Let's look at the data center boom. It's one thing to announce hundreds of billions of dollars in spending. It's another to actually see the results. That is a lot of money. To measure that, I use data from the Synergy Research Group Hyperscale Data Center Tracker. That is a lot to say, which tracks operational hyperscale facilities around the world, as well as projects currently moving through the development pipelines. And what does the data show? By the end of 2024, there are more than 1,100 operational hyperscale data centers worldwide. And in 2024 alone, more than 130 new facilities came online. What's even more interesting is what came next. According to the same data set, there are more than 500 additional hyperscale facilities currently in various stages of planning, construction, or deployment. In other words, this industry isn't slowing down. The build-out is continuing. And these aren't the same facilities that were being built a decade ago. They're larger, they're more compute dense, and increasingly, they're becoming designed specifically for AI workloads. And this is one of the reasons the AI story has become so important. We're no longer talking about software alone. We're talking about physical infrastructure being built at a global scale. And now it's important to recognize that this growth hasn't happened without controversy, right? Across the United States and around the world, data center projects have increasingly faced pushback from local communities, regulators, and utility providers for good reason, right? There's concerns around electricity demand. You have one in Utah where the new data center uses the same amount of power as what is currently being used for the state of Utah, okay? Water consumption, land use, and pressures on existing infrastructure, okay? And that's not the focus of this analysis, but it's important to call it out, right? Because it is justified. But the fact that these debates are occurring tells us something important. Data centers have become large enough to matter, right? It is the story of the topic of what's happening right now. And that's where the story starts to change, because the number of facilities being built isn't only part of the equation. The real challenge isn't how many data centers exist, it's how much electricity they're going to require once they are operational. And when you look at power demand, the numbers become even more dramatic. At this point, the evidence is pretty clear. The money is being spent, the data centers are being built, and AI infrastructure is expanding rapidly. The next question I wanted to answer was simple. How much power does all of this actually require? To answer that, I pulled data from two sources. For global estimates, I use the International Energy Agency's Energy and AI Report. And for US estimates, I use research from Lawrence Berkeley National Laboratory on data center electricity consumption. What both data sets show is the same basic trend. Power demand is accelerating. Globally, data center electricity consumption is expected to increase from roughly 415 terawatt hours in 2024 to approximately 945 terawatt hours by 2030. And that's more than a doubling in just 6 years. The US story is similar. Data center electricity consumption has already increased dramatically over the last decade, and projections suggest it could reach between 325 and 580 terawatt hours by 2028. To put that into perspective, that would represent a meaningful share of total US electricity demand. And that's where the conversation starts to change, because we're no longer talking about servers, we're no longer talking about GPUs, we're not talking about software, we're talking about electricity. Real electricity that has to be generated, transmitted, and distributed, and delivered to physical facilities. A typical AI-oriented data center can consume as much electricity as a small city. The largest facilities currently under development require power levels that would have been difficult to imagine just a decade ago. And this is one of the reasons data centers have become such a controversial topic. As demand rises, communities, utilities, regulators, and developers are all asking the same question. Can the existing grid support this level of growth? Because while the demand side of the equation is moving incredibly fast, infrastructure doesn't move at the same speed. Power plants take time. Transmission lines take time. Substations take time. Transformers take time. And that's where the real bottleneck begins to emerge. The challenge isn't simply generating enough demand for AI. The challenge is delivering the infrastructure needed to support it. And when you start looking at the timeline involved, you begin to understand why so many people are worried about capacity constraints. At first glance, this seems like a simple problem. If AI needs more electricity, why not just build more infrastructure? Why not build more power plants, more transmission lines, more substations? The problem is that infrastructure doesn't move at the speed of software, and it doesn't even move at the speed of semiconductors. To understand why, I compiled data from utility filings, grid operators, industry reports, manufacturing studies, interconnection queue data, and infrastructure research covering the major components required to bring new power online. And what I found was something surprising. There isn't a single bottleneck There are bottlenecks everywhere. Let's start with transformers. Power transformers are one of the most critical components in the electrical system, and lead times have exploded. In many cases, utilities are reporting wait times of roughly 128 to 143 weeks. That's more than just 2 years just to receive equipment. Next comes transmission infrastructure. Building new high voltage transmission lines often take 4 to 8 years due to permitting requirements, environmental reviews, land acquisition, engineering, and construction. Then there are large frame gas turbines. As utilities rush to add generation capacity, demand has surged faster than manufacturing capacity. Some projects are now facing lead times exceeding 5 years. And substations face similar issues. Equipment shortages, engineering constraints, construction backlogs are creating delays measured in years rather than months. And even if all of this infrastructure is ready, projects still have to move through interconnection queues across many regions. Developers are waiting years just to receive approval to connect new projects to the grid. And then there's one final bottleneck that often gets overlooked: semiconductor manufacturing. Advanced fabs require enormous amounts of capital, engineering talent, permitting, and construction time. Many of the capacity expansions currently underway won't have their full impact until the 2027 to 2029 timeframe. And when you put all these constraints together, a pattern starts to emerge. AI demand is accelerating rapidly. Infrastructure supply is not. The issue isn't a lack of capital. The issue isn't a lack of demand. The issue is time. Data centers can be planned quickly. GPUs can be ordered relatively quickly, but the infrastructure required to support them often takes years to deliver. And that's why many analysts now view infrastructure as the critical constraint on future AI deployment. Not because the technology isn't advancing, but because the physical systems underneath it can't expand overnight. And this raises an important question. If these bottlenecks are real, how large could the gap become? And to answer that, I built 4 analytical models. At this point, we've covered a lot of ground. We've looked at capital spending, data center growth, electricity demand, infrastructure bottlenecks. But before we can go any further, I want to explain exactly how I approach this analysis, because every conclusion in this video comes from a set of analytical models. And those models were designed to answer one central question: is AI infrastructure investment driving electricity demand faster than infrastructure can realistically expand? Instead of relying on a single metric, I built 4 separate models that attack the problem from different angles. Each model answers a different question, and together they create a framework for understanding what is actually happening beneath the surface. The first model is a power demand regression model. Its job is simple: identify which factors are most strongly associated with changes in electricity demand. In other words, what variables actually matter. The second model is the delay and stress analysis. This model measures where demand growth is beginning to outpace infrastructure growth. Not where problems might occur someday, but where pressure is already building today. The third model is an infrastructure clustering model. This groups regions with similar infrastructure characteristics together and helps identify where stress is becoming concentrated. Think of it as a way to separate areas that appear healthy from areas that show early warning signs. And finally, the fourth model is a scenario model. This is where I test different future outcomes. What happens if AI demand grows moderately? What happens if it accelerates? And what happens if infrastructure expansion can't keep pace? Together, these 4 models move from correlation to stress to location to projection. Each model builds on the previous one. And by the end, they provide a much cleaner picture of where infrastructure constraints may emerge and how severe they could become. But before we can run any models, we need data, a lot of data. So next, let's look at the data sets that power this entire analysis and where every number in this project came from. Okay, so for the data for this analysis, I combined 6 major data sets, okay? So first, a quick note on the geography of this analysis. Throughout this project, you'll hear me reference PJM. PJM is the largest power grid operator in the United States. It coordinates electricity generation and transmission across 13 states and Washington, D.C., serving roughly 65 million people. I focused on PJM because it contains some of the largest concentrations of data center development in the world, including Northern Virginia, which is widely considered the largest data center market on the planet. Then I also talk about SEC filings. Okay. Specifically, I collected annual capital expenditure data from company 10K filings, annual reports, investor presentations, and earnings materials from major hyperscalers, including Amazon, Microsoft, Google, Meta, and others. Rather than relying on analyst estimates, I wanted the spending numbers directly from the companies themselves. So this data set allows us to track how infrastructure investment evolved from roughly 36 billion in 2011 to approximately 246 billion by 2026. Okay? All right, so let's jump back here. Okay, so the first data set tracks hyperscaler capital expenditures using the SEC filings that I mentioned. And this gives us a view into how much money is actually being deployed into AI infrastructure over time. I also mentioned PJM. The second data set comes from PJM and tracks system-wide load, capacity, reserve margins, and reliability metrics. And this helps us understand what is happening across the electrical system as a whole. The third data set breaks the same information down to the regional level. Instead of looking at PJM as one giant system, we can see where demand is growing and where infrastructure pressure is beginning to emerge. The fourth data set tracks planned and active infrastructure projects, transmission upgrades, grid expansions, new equipment deployments, the projects that are supposed to help support future growth. And the fifth data set comes from PJM wholesale electricity markets. These prices act like signals. When supply and demand become imbalanced, prices often react long before the physical infrastructure does. And finally, I mapped active and planned data center locations across the United States. This allows us to connect infrastructure investment and electricity demand to places where AI infrastructure is actually being built. And when combined, these data sets create a chain of evidence. Investment drives infrastructure deployment, infrastructure drives electricity demand, demand creates pressure, pressure creates bottlenecks. And bottlenecks ultimately determine whether growth can continue. And together, these data sets contain over a decade and a half of historical observations, thousands of infrastructure projects, millions of electricity market records, thousands of data center locations, and the capital spending history of the companies building the AI ecosystem, right? So now that we have the data foundation established, let's move into the first model and answer that simple question. As hundreds of billions of dollars was poured into AI infrastructure, did electricity demand move with it? And to answer that question, I combined 2 data sets. For investment activity, I collected annual capital expenditure data from major hyperscalers using SEC filings that I talked about earlier. For electricity demand, I used load data from PJM, which is the largest wholesale electricity market in the United States. And I talked about them earlier as well. And so once those data sets were assembled, I built a regression model to measure the relationship between hyperscaler investment and electricity demand across PJM from 2011 to 2016. The idea behind the model is straightforward. If AI infrastructure investment is influencing electricity demand, we would expect regions receiving the most AI-related activity to show stronger relationships than regions receiving little or no data center development. And to measure that relationship, I used R-squared values. Think of R squared as a measure of how closely two variables move together over time. Higher values indicate a strong relationship, lower values indicate a weak one. So let's start with the growth comparison chart on the left, the top middle left. The first thing that stands out is the difference in growth rates. Capital expenditures increased from roughly $36 billion in 2011 to approximately $246 billion by 2026. That's an increase of more than 580%. During the same period, PJM load increased from roughly 116,000 megawatts to 141,000 megawatts, about 21% growth. At first glance, those numbers don't appear to move together very closely. But that's exactly why I moved beyond the system level and examined individual PJM regions. Looking at the regional regression results on the right side of the slide, one region stands out immediately. DOM, that's Dominion Energy Territory in Northern Virginia, the same region that contains the largest concentration of data centers in the world. Among all PJM regions, DOM produced the strongest relationship between infrastructure investment and electricity demand. If you look at the top regional ranking, DOM generated an R-squared value of approximately 0.71. Several other regions also showed meaningful relationships, but none approached the strength of DOM. The summary metrics in the center of the slide tell the same story. The strongest relationship appeared in the exact region where AI infrastructure is most heavily concentrated. And that's an important observation because the signal didn't appear randomly. It appeared exactly where we would expect it to appear if AI infrastructure expansion is beginning to influence electricity demand. Now, this doesn't prove causation. It doesn't prove that hyperscaler spending directly caused the increase in demand, but it does give us our first meaningful clue. The regions receiving the most AI infrastructure investment also appear to be showing the strongest relationship with electricity demand growth. And that's exactly what we expect to see if AI infrastructure deployment is starting to show up in power system. But this raises another question. If AI investment is influencing demand in specific regions, has it become large enough to change the behavior of electrical systems as a whole? And that's what I wanted to test next. All right, so to answer that question, I went back to the PJM load and capacity data and analyzed system-wide trends, this time from 2011 to 2016. This model focuses on four metrics: peak load, scheduled capacity, reserve margins, and a stress core based on the ratio between load and available capacity. The goal is simple. Look for evidence that the system has entered a new regime, something that would suggest AI infrastructure has fundamentally changed the trajectory of electricity demand. Let's start with the PJM system summary in the upper left corner. From 2011 to 2016, peak load increased from approximately 116,000 megawatts to 141,000 megawatts. That's about 21% growth over 5 years. During the same period, scheduled capacity increased from roughly 152,000 megawatts to 167,000 megawatts. Reserve margins remained relatively stable, and stress core increased only slightly. At a high level, nothing here immediately suggests a system under severe pressure. So next, let's look at the PJM system peak load trend chart in the top center. Instead of seeing a sudden acceleration, demand appears to grow gradually over time. The line trends upward, but there is no obvious point where demand suddenly breaks away from its historical pattern. So to formally test that, I use what's known as a structural break analysis. You can see the results in the structural break test chart on the upper right portion of the slide or the image. The purpose of this test is to determine whether the underlying behavior of the system changed in a statistically significant way. In simple terms, we're asking, did PJM suddenly enter a new demand regime, Or is it still behaving like the same system we've observed for years? The test compares the observed data against statistical thresholds that would indicate a meaningful shift. If the blue line crosses the critical threshold, we would have evidence of a structural break. But as you can see, it never comes close. So the test found no statistically significant break in system-wide demand. The lower chart tells a similar story. Looking at the PJM system trends chart in the bottom left, peak load, capacity, reserve margins, and stress scores all remain relatively stable over time. Looking at the annual change chart in the bottom center, most yearly load changes fall within a fairly normal range. We don't see the type of explosive year-over-year growth that would suggest the entire PJM system is suddenly being overwhelmed by AI infrastructure. And the yearly snapshots table on the right confirms the same conclusion. The system has grown, but it hasn't fundamentally changed. So what does Model 2 tell us? It tells us that while AI investment appears to be influencing specific regions, particularly Northern Virginia, that influence has not yet translated into a system-wide surge in PJM demand. And that's actually an important finding because it suggests the story may not be happening everywhere equally. The pressure may be concentrated in specific locations rather than spread evenly across the entire grid. Which leads directly to the next question. If the overall system looks relatively stable, where exactly is the stress building? And that's what I wanted Model 3 to answer. And to answer that question, I built a clustering model using the regional PJM datasets. For each PJM zone, I calculated 6 metrics: load growth from 2011 to 2026, capacity growth over the same period, and the gap between those numbers, average load to capacity ratio, maximum load to capacity ratio, and a composite infrastructure stress score. The idea is simple. If load is growing faster than capacity, stress should increase. If capacity is growing as fast or faster than load, stress should remain manageable. After calculating those metrics for all 10 PJM regions, I used clustering techniques to group similar regions together. And the result was 3 different infrastructure profiles. Let's start with the cluster overview panel in the upper left corner. The model identified 3 groups: emerging capacity regions, potential bottleneck regions, and infrastructure-ready regions. The emerging capacity group contains regions where demand is growing quickly and infrastructure is beginning to feel pressure. The potential bottleneck group contains regions where capacity is struggling to keep up, and infrastructure-ready regions appear to have enough capacity growth to support current demand trends. Now look at the cluster visualization chart in the upper center. This is the PCA visualization. Think of it as a way to reduce multiple infrastructure variables into a 2-dimensional map. Regions that appear close together have similar infrastructure characteristics. Regions farther apart behave differently. Notice how the purple emerging capacity region clusters together. The green infrastructure ready regions form their own group, and Dayton sits almost completely isolated from everything else. And that separation is important. It suggests Dayton's infrastructure profile is fundamentally different from the rest of PJM. Now let's move to the infrastructure stress leaderboard in the upper middle right section. The table ranks all 10 PJM regions using the calculated stress metrics. At the top, we find Dayton, AP, EKPC, DOM, which is in Northern Virginia, and mid-ATL. The table is important because it shows exactly how the rankings were calculated. All right, it's based on measurable differences between load growth and capacity growth. For example, DOM posted roughly 49% load growth, but only 24% capacity growth. EKPC shows similar behavior. AP also showed low growth, substantially exceeding capacity growth. And those gaps are what push regions higher on the stress leaderboard. The cluster metrics table in the upper right summarizes the averages for each cluster. Notice how the potential bottleneck cluster shows the highest load capacity growth gap, the highest average load ratios, and the highest maximum load ratios, and the highest overall stress scores. Every metric points in the same direction: higher stress, higher risk, higher vulnerability to future demand growth. The load growth versus this capacity growth chart in the lower left helps visualize this. The horizontal axis represents capacity growth. The vertical axis represents load growth. Regions positioned farther left are seeing capacity growth lag behind demand growth. Regions positioned farther right are seeing infrastructure expand more quickly. Notice where DOM, AP, and EKPC sit. Their load growth is significantly outpacing infrastructure expansion. And that's exactly the pattern we expect if pressure is beginning to build. Now look at the load to capacity ratio over time chart in the lower middle section. This chart tracks average infrastructure stress by cluster over time. The green infrastructure ready cluster remains relatively stable. The purple emerging capacity cluster trends gradually upward. But the orange potential bottleneck cluster separates dramatically from the others. Its ratio continues rising year after year. And that divergence suggests infrastructure pressure isn't temporary, it's accumulating. So what does this all tell us? It tells us that PJM isn't experiencing one uniform story. Some regions appear relatively well positioned, others are beginning to show signs of strain. And a small group of regions, including Northern Virginia, EKPC, and AP, are displaying the strongest indicators that demand growth is outpacing infrastructure growth. But identifying stress today isn't enough. The bigger question is what happens next? What happens if AI demand keeps accelerating? What happens if data center construction continues expanding? What happens if infrastructure growth can't keep up? And that's exactly what I built Model 4 to explore. So one challenge with every model we've looked at so far is that they all are based on historical data. They're telling us what happened. They're not telling us what happens next. And that's where Model 4 comes in, because the real question isn't whether infrastructure stress exists today. The real question is what happens if AI demand keeps growing faster than infrastructure can be built. And so for this final model, I built a scenario framework. It's not a forecast, not a prediction, a scenario model. The difference matters. A forecast tries to predict what will happen. A scenario model asks, if these assumptions are true, what would the consequences look like? And to build a model, I started with the actual 2026 PJM baseline. Approximately 141,580 megawatts of load, approximately 167,072 megawatts of available capacity, and a reserve margin of about 25.6%. Those values come directly from PJM datasets we've been using throughout the whole analysis. So I then created 3 demand and capacity growth scenarios. And the assumptions are shown in the scenario assumptions panel on the upper left corner. The base case assumes load growth at 2.5% annually, while capacity grows at 1.5%. The bull AI case assumes load growth at 4.5% annually, with capacity growing at 2%. And the extreme AI adoption case assumes load grows at 7% annually, with capacity growth at 2.5%. For each scenario, I compounded both load and capacity forward year by year. Then I calculated the future capacity gap, which is simply projected capacity minus projected load. Positive values indicate surplus capacity. Negative values indicate shortfalls. Now let's look at the PJM system capacity gap over time chart in the center of the slide. This is the main output of the model. The blue line represents the base case, the orange line represents the bull AI case, and the purple line represents the extreme AI adoption case. Notice what happens. In the base case, the system actually remains healthy. The capacity surplus grows over time. In the bull AI case, the surplus gradually shrinks but remains positive through most of the period. But in the extreme AI case, the trend changes dramatically. Around 2030, the line crosses below zero. And that's the point where projected demand exceeds projected capacity. The model moves from surplus into deficit. The PJM system summary table on the upper right shows the actual numbers behind those curves. Under the base case, PJM still maintains roughly 21,000 megawatts of excess capacity. Under the bull AI case, the surplus falls to roughly 12,000 megawatts. But under the extreme AI case, the model produces a capacity deficit, reserve margins disappear, and the load capacity ratio exceeds 1. And that's the threshold where the system begins running beyond available capacity. But one of the most important findings isn't visible at the system level. It's visible at the regional level. Look at the projected regional capacity shortfall by 2030 chart in the lower left section. This chart uses the stress regions identified in Model 3. For each region, I applied the same scenario growth assumptions and projected future load relative to local capacity. What we see is that regional deficits appear much earlier than system-wide deficits. In every scenario, DOM and mid-ATL consistently show the largest projected shortfalls. That matters because infrastructure problems rarely appear everywhere at once. They usually emerge in specific regions first. The projected load to capacity ratio by 2030 table in the lower middle section tells the same story in another way. A ratio above 1 means projected demand exceeds projected capacity. Under the extreme AI scenario, every region shown exceeds that threshold, some by a substantial margin. EKPC approaches 1.9, DOM approaches 1.8, mid-ATL exceeds 1.3. These are not predictions, they are stress tests, but they show how sensitive the system becomes when demand growth accelerates faster than infrastructure growth. And that's really the key takeaway from this model. The future outcome depends almost entirely on the relationship between two growth rates, demand growth and infrastructure growth. Small differences between those two variables create dramatically different outcomes over time. So what does Model 4 conclude? Well, it concludes that infrastructure isn't necessarily failing today, but under aggressive AI adoption scenarios, infrastructure can become the limiting factor surprisingly quickly. Regional shortfalls appear first, system-wide shortfalls appear later, and the difference between those outcomes is largely determined by how quickly new infrastructure can be delivered. At this point, we've completed all four models. We've looked at investment, we've looked at historical demand, we've identified where infrastructure stress is building, and we've tested what could happen under different future scenarios. So now it's time for the final question. What does all of this actually tell us? Has the market underestimated the infrastructure challenge, or has Wall Street already priced it in? Let's bring all four models together and make a final judgment. Okay, final judgment. Can the world support AI? So let's start with what the data says, and at the end, I want to give some personal opinions and thoughts on it as well. So, can capital support AI? The answer appears to be yes. Throughout this analysis, we saw hyperscaler capital expenditures explode roughly $36 billion in 2011 to more than $246 billion in 2026, right? Microsoft, Google, Meta, Amazon, collectively, they're spending hundreds of billions of dollars every year building AI infrastructure. And importantly, Nothing in the data set suggests they're running out of money. Cash flow remains strong, balance sheets remain healthy, private capital continues pouring into the sector. If AI needs more money, the financial markets appear willing to provide it. Can data centers support AI? For now, the answer also appears to be mostly yes, but the data showed that operational data centers doubled in roughly 5 years. More than 1,100 facilities were operational by the end of 2024. Another 500 plus facilities were already somewhere in the planning, construction, or fit out process. And perhaps most importantly, capacity isn't just growing because we're building more buildings. The buildings themselves are getting larger, denser, more powerful, and the physical industry is scaling aggressively. So if someone argues that AI can't build enough data centers, the evidence doesn't really support the conclusion, at least not today. So, but then we reach the third question. Can infrastructure support AI? And this is where the answer changes. Not because the industry lacks ambition, not because the industry lacks capital, but because infrastructure operates on a completely different timeline. Throughout the analysis, we've repeatedly found the same pattern. Demand can accelerate quickly, infrastructure cannot. Transformers take years, transmission projects take years, substations take years, interconnection approval takes years. Even when money is available, physical infrastructure still has to be designed, permitted, manufactured, and built. And none of those processes move at software speed. Model 1 showed that investment is becoming increasingly concentrated in regions like Northern Virginia. Model 2 showed that system-wide demand hasn't yet broken historical trends. Model 3 showed that infrastructure stress is already emerging in specific regions. And Model 4 demonstrated how quickly those pressures can become shortfalls if demand growth accelerates faster than infrastructure growth. And now that's important because this is where many conversations about AI become oversimplified. People often assume that if enough money exists, the problem gets solved. But infrastructure doesn't work that way. You can't instantly create transmission lines. You can't instantly manufacture transformers. You can't instantly expand grid capacity. They are all real world physical limits, and those limits don't care how much venture capital is available. So, what's the final judgment? Based on everything we've analyzed, capital is not the constraint, data centers are not the constraint, infrastructure is the constraint. And that doesn't mean AI growth stops, right? But the next decade may be defined less by algorithms and GPUs and more by transformers, substations, transmission lines, generation capacity, and grid modernization. In other words, the biggest challenge facing AI may not be computing, it may be electricity. And if that's true, then the winners of the next phase of the AI trade may not simply be the companies building the models, they may be the companies building the infrastructure that makes those models possible. Think about that. Remember that. Key takeaway. So, can the world support AI? Yeah, my answer is yes, but only if infrastructure can catch up. Because the question was never whether we could build smarter machines. The question is whether we can build the physical systems needed to power them. And based on everything we've seen, that story is just beginning. And to end, I want to give some personal thoughts, okay? One thing I didn't focus on in this analysis is revenue generation or revenue growth. Much of the growth we're seeing is being driven by spending, right? Hyperscalers are spending money. You have Google, Amazon, Meta, all of them spending money, which then becomes revenue for chip makers, networking companies, memory providers, construction firms. And the question is whether that spending ultimately generates enough economic value to justify the investment, right? Is that truly organic revenue growth, or is money just moving between companies, right? And so that wasn't addressed, but I think that's something to truly think about, right? What is the revenue generation side of this? Okay. So much has been on that spend, and that spend is generating revenue, but is that truly organic revenue growth? Second, you still have social. Okay, next thought. So you still have social and political factors related to AI, right? Is AI going to take my job, or are these data centers going to destroy the environment? Those are real world constraints in the same way as infrastructure. While big tech companies have embraced AI, that doesn't mean society has yet, okay? So there's still a lot to be discussed on this front as we move forward. You can price all this growth, but there's certainly a risk to it just based on adoption, right? If people think something's going to take their job, they're not going to adopt it, okay? And also you have permitting battles, right? Water usage concerns, which is huge. You know, the power allocation disputes, labor concerns, okay? There's an example about in Tahoe. You can look that up. I don't want to get into too much details about it, but yeah, there's real world societal and political factors related to AI. I think if it was a product that was being more accepted in society, you would see different reactions, but there's part of that aspect where you're seeing all this money going into it, and society as a whole hasn't necessarily embraced it all the way yet. And that's just my opinion. Okay. All right. Next thought. Let's say I highlight this as infrastructure should have come first. Okay. Right. One thing that stood out to me is that AI deployment appears highly uneven. Certain parts of that deployment are attracting enormous amounts of investment, like Micron memory. You just saw their stock go from like $100 all the way up to $800 in like a month, right? Historically, when capital floods into a small number of areas, expectations can become disconnected from reality, and that's something worth paying attention to, right? That is a big story or a big concern. I think if you were to do this correctly, because the deployment is not following a linear relationship, right? It's very non-linear. You would have started with your infrastructure, made sure everything, the infrastructure could support the grid and meet all your demand, but instead you're just kind of building these data centers, and then the electricity demand, everything else has become an afterthought, very like an agile style, right? So interesting as well. All right, next thought. It also concerns me how concentrated the AI story has become. Healthy economies usually have multiple engines of growth, right? Today, an enormous amount of capital, attention, and market value is flowing toward a relatively small group of companies and themes, right? You have these companies with trillions and trillions of dollars market cap, right? Concentration can create incredible winners, but it also creates vulnerability if expectations prove too optimistic, right? If this AI does not work out and you have a lot of money in one area, well, that could be a lot of money lost as well. So next thought. Overall, I think there are positives to AI. I don't want to paint some doom and gloom story here. As somebody who got a master's in data science, part of that curriculum is learning how to train AI or machine learning models. So being on that back end, building LLMs, all that. So there's a lot of great aspects to it. I've seen it and used it for various projects for good. But yeah, there are those stories out there where doom and gloom, but you got to kind of balance the two, right? And just like in this presentation, I used AI to create many of the images in this presentation. To do that on my own might have taken me hours, where AI was able to complete it in minutes. You know, and the technology isn't perfect. You can probably spot some inconsistencies throughout the video of the images. They're sometimes in different colors and all this type of thing, and it can drift. So it's not perfect, right? But it's difficult to ignore the productivity gains you can have when using it. And the last final thought. Infrastructure doesn't move at the speed of software. If demand grows faster than the system supporting it, somebody eventually bears the cost, whether that's consumers, businesses, utilities, or local communities. Shortages and constraints don't simply disappear because investment capital exists. Infrastructure takes years to build. And that is the central challenge that I want you to think about when you see this. When you hear all these stories about growth, think about those other aspects as well, right? How long is the infrastructure going to take to handle this? Is that infrastructure harming communities, the environment, things like that? So there's a lot of factors that can go into it. I know right now there's a lot of money flowing in and it's exciting. You can see these stocks going from $80 to $800. Okay. And so just be careful as you think about that long term and as you're planning your investments and what you want to do. There are things associated with this that aren't fully there, developed, or ready yet as well. All right. So I appreciate that. Thank you, everybody. I hope you enjoy this. Stay tuned for the next video. All right. Bye.